Imagine you just got your quarterly portfolio statement, your balance is up, your allocation looks reasonable. You scan the statement for about 90 seconds and you think, yeah, it looks good, and you move on. Most people do exactly this, and most of the time, nothing bad happens. But there are many things that can be wrong in your portfolio that the statement was never designed to tell you about, and that's exactly what we're here to uncover today. Stay tuned.
Welcome to Personal Finance for Long-Term Investors, where every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 146. I'm Jesse Kramer. I'm a financial planner. I work with retirees and people getting ready for retirement from all across the USA. You can learn more at planwithjesse.com. The link is in the show notes. Our review of the week is from PDC 2025, that's Papa Delta Charlie 2025, who left a 5-star review that included the words, quote, "This is hands down the best podcast," in his review or in her review. And you know what? That's all I needed to hear. This is hands down the best podcast. Thank you, PDC 2025. I would love to send you a Super Soft Podcast t-shirt. So please drop me an email to jesse@bestinterest.blog and I will get that mailed out your way. Now, one of the more interesting parts of my job is that when a new client comes to work with me, I get to take a deep dive into all of their investment account statements. And if you've never looked hard at your account statements, that's totally okay. A typical investment account statement shows what you own, what's happened recently, how you've done, and some basic account info. So what you own would be, the specific investments held in the account, how many shares or units of each investment, the current market value of each holding and the total account value, stuff like that. What's happened recently would be things like transactions that have occurred during the statement period, buys, sells, dividends received, contributions or withdrawals, things like that. Any fees or commissions charged, though this is an interesting one, and we'll certainly come back to this one, because some fees and commissions are explicit, and you see them very obviously written right there on your statement, but many are implicit, and you would actually never know that they've affected your account balance. There's no evidence that they've been deducted, so to speak, from your account balance. You simply have to realize that they're there, even though you can't quite see them. I'll explain that later in the episode. The third thing I mentioned before is how you've done, right? It was what you own, what's happened recently, how you've done, and some basic account info. So the how you've done would be your account's return over the given period of the statement. Sometimes that's compared to a particular benchmark like the S&P 500 or something like that. Beginning balance, ending balance, again, any sort of evidence to show how your account has done over the period. And then last, the basic account info, meaning, what kind of account type is it? An IRA, a taxable brokerage account, a 401k, a 529, something like that. The account owner's name and address. Sometimes the beneficiaries are included there, especially if it is the kind of thing of like an inherited IRA or a 529 account. Who's the beneficiary of the account? And last, the custodian or the brokerage holding the assets is obviously something very important. So all of that information is on your account statement, and that's just the surface level, though. That's the surface layer, maybe I should say. It's the stuff that anyone could read in a few minutes. But that surface layer metaphor really is perfect here, because just like on a body of water, there's a lot more going on underneath the surface than whatever is floating on top of the surface. It's easy to simply ignore what's going on underneath, but probably to your own detriment. So let's dive in, get it? To the many interesting things that you can glean from your investment account statements. That's what we're talking about all episode today. First things first is why? As I got my start in the financial planning industry, I would often review an investment statement and a voice in my head would want to kind of scream out, why? What is going on here? Why does this portfolio have 47 individual stock positions? Why did they sell this fund at a loss and then rebuy that same fund 2 weeks later? Why does every single fund in this account happen to be managed by the same firm as the broker who sold it to the client in the first place? Now, candidly, I would ask a lot of these questions thinking in my head, this is bad, this is stupid, this doesn't make any sense, and this needs to change. That would be the kind of the voice underneath me saying why. And one thing I've learned over time is that I probably did, and maybe still do, rush to judgment too often. Most portfolios have really interesting stories in them. This portfolio with 47 individual stock positions, it has those stocks because I inherited them from my grandpa's testamentary trust, and I actually did not get a step up in cost basis, so I wasn't sure if I could sell it. Right off the bat, that's an interesting story. And rather than thinking this is bad, this is stupid, this is wrong, I've learned that a much better approach is simply saying, I don't understand this. I don't understand this. Why is this the way it is? Help me understand what's going on in your portfolio, Mrs. and Mr. Client. But that idea, I don't understand this. Why is this portfolio the way it is? Those are the questions that are really going to help us in today's episode. I'm going to describe a few of the lenses through which I look at portfolio construction. These lenses, as you'll see, are all important to a good financial plan. And as we look through these lenses and as we ask that question of why, I think you'll learn a lot more about how you can begin evaluating your own portfolio, or if you're helping other people in your life, how you can evaluate their portfolios. The first big lens that I always use is to take a broad view of risk and reward. What kind of investment risks exist inside this portfolio? Why are those risks being taken? And are there any outsized risks that don't appear to offer some sort of commensurate reward? To do this, we want to look at the broad allocation decisions for the entire portfolio. How much of the person's investments are in stocks, are in bonds, are in cash, are in other assets like real estate or precious metals or private offerings. We look at this first because it's the single biggest driver of long-term returns. Everything else is noise compared to this broad risk and return analysis. And everything else is just noise if we get this thing wrong. So we look at it first. So how do we know if it's right or wrong? It's hard to say if it's right or wrong if all we do is look at the investments alone. This is why I'm such kind of an annoying snob for a good financial plan, and more specifically for a good understanding of a person's future cash flow needs. If we know what the portfolio needs to do, and that is if we know how much money is needed from the portfolio over a specific period of time, right? When that money is needed. If we know those things, then we can build a broad asset allocation to meet those needs. The idea of a risk-adjusted return probably deserves a little bit of sunlight right here. Now, candidly, risk-adjusted return is usually a little deeper of a topic than I would pay attention to on a daily basis. But what it means is it measures an investment's profit relative to the amount of risk taken to generate that profit. It tells you if a high return is actually impressive, or if that high return is simply the result of taking on reckless volatility. And so a risk-adjusted return allows for some sort of an apples-to-apples comparison between different investments. A very simple example. Some investors might say that GameStop, the company that sells used video games that was made famous in 2021, I think, some investors might say that GameStop is a better investment than Treasury bonds, simply because GameStop has had higher returns over the past 10 years. But really what they're saying is they're saying that GameStop has had more of a reward. And that's absolutely true. GameStop has had more of a reward. But reward is only one half of the coin in investing. The other half is risk. And GameStop investors, I would argue, have taken on immense levels of risk. And most of them actually obtained relatively poor rewards compared to the risk that they took. And risk-adjusted returns is an attempt, at least, as the name would imply, to adjust the returns of an investment based on the risk being taken. So the returns in an account only show the returns, right? It only shows the returns. It doesn't actually show the risk. So that's one of the things that I'm looking at when I take this broad view of asset allocation, is trying to understand the risk and reward that exists inside of a portfolio. Now, at this stage in the portfolio investigation, I usually look at a report that tells me the sum total portfolio allocation, and that also usually produces an account-by-account allocation illustration too. So let's do that next. If we've already looked at the individual's total allocation across all their various accounts, the next thing I usually dive into is the account level allocation. Now, typically, a retiree might have traditional pre-tax accounts. Many retirees might have a Roth account, taxable accounts too. Some couples only have 2 or 3 accounts total. Other couples, I should say, have 10 or 15 or even 20 different investment accounts. I want to understand how each account is allocated. Again, this information typically signals some decision or conversation that might have happened years ago, and there are these little hints hiding within the account allocations that kind of, again, they hint to me that, there's some rationale going on here. There's some reason for this particular allocation. And this level of analysis is often where we start to see some of the low-hanging fruit, so to speak. So what do I mean by that? Well, some easy ones could include too much cash sitting inside an account, whether it's just straight up cash or a money market fund or an ultra short-term treasury. Just the other week, I was looking at a prospective client's accounts, and out of a $5 million portfolio, this person had about $200,000 sitting in a taxable account. And of that $200,000, over $150,000 was sitting in cash. Now, this to me is the classic example of where I would ask why. There might be a perfectly good reason for having that $150,000 sitting in cash, a perfectly good reason that I'm not aware of, that I don't fully understand, but I'm going to flag it as a reason to ask why, because there's also a really good chance that there should not be that much money sitting in cash, and some of that money ought to be invested. Another one of the low-hanging fruit that we look at when we're doing account-by-account allocation decisions is what's called tax location. Which assets are in which accounts and why. In a perfect tax-focused world where we only care about taxes, you would probably hold all of your bonds in a traditional IRA. You'd avoid holding bonds or REITs inside of a taxable account. You'd like to hold your highest growth assets all in Roth accounts. But this certainly adds complexity to your life, and we don't always have enough money in each account to make this work. And if we actually look at all the numbers, optimizing for tax location isn't always that big of a draw. It doesn't always lead to that much of an outsized return in the long run. But nevertheless, when we're looking at account level allocation, we can take notes. We are looking for things like tax location. We're looking to understand why a particular person has decided to allocate whatever assets they have into whatever accounts they have. Why are they choosing a brokerage account over an IRA as the place to hold all of their bonds? Things like that. Why? Again, we're always asking that question. Once we've looked at the account by account level allocations, using my third analysis filter, I'm looking at the tactics or the methodologies or the philosophies that exist inside the portfolio. And I think the fourth filter is also worth mentioning here, and that's where I'm looking at specific securities, because the specific securities often can kind of tell me the story of the tactics or the methodologies or the philosophies being implemented. So what does that all mean? Here's an example. If a portfolio is full of single stocks, or is the portfolio full of mutual funds and ETFs? If it is full of only individual stocks, which stocks? Is there a discernible pattern like large cap US stocks or dividend and value stocks or all tech and all growth stocks? If it's full of mutual funds and ETFs, are they all low cost and passive? Are they all actively managed? Is there a tilt toward a value or small caps or something else? Those are the kind of questions I'm asking myself in the third and fourth filter here. Again, I'm looking for the tactic or methodology or philosophy at play. And oftentimes I'm looking at the individual securities that someone owns, the individual stocks, the individual funds that someone owns, because that's going to inform me about what kind of investment philosophy is going on here. On the bond side of the portfolio too, similar questions. Are this person's bonds all US Treasuries? Are there corporate bonds or mortgage-backed bonds or municipal bonds in here too? Is it all bond funds? Do they also own some individual bonds? I'm trying to put myself inside the head of whoever created this portfolio and see if I can understand that kind of why pattern behind whatever they chose to do. And this is less about whether one philosophy is better than another. Again, I have my own personal investment philosophies, but I'm not looking to criticize a philosophy that's different than mine here. I'm trying not to go in with blinders on. I'm not looking for evidence only of my style of investing versus, all those other styles of investing. Instead, I just think it's important to ask, is there a consistent philosophy throughout this portfolio? Does this investor actually understand that philosophy that exists inside their portfolio? Some of the stories that you get when you're using these third and fourth filters can be really, really interesting, and maybe they'll resonate with you listening right now. I was recently speaking to a listener who considers himself part of the FIRE movement, financial independence movement. He said he discovered it about 5 years ago. But for the last 20 years, he's worked with the same Wall Street broker who he inherited from his dad. And so when I looked at his account, among other asset classes, he had $2.5 million invested in the global stock market. Okay. It was about 1/4 US mutual funds, some passive, some active, 1/4 international mutual funds, again, some passive, some active. And the remaining half of his stock allocation was all invested in individual stocks. And looking at his stock market exposure, it was hard to find one cohesive philosophy or one singular thought process, but instead it was just kind of a smattering of different ideas, of different philosophies. And there are multiple problems here. We could talk about passive versus active investing. Why exactly is he doing both? And more specifically, I'd say, why is there any active management going on? Like, what is the story behind that active management? We should and could also talk about investing in funds versus investing in single stocks. Again, why both? And when it comes to those single stocks, again, more often than not, trying to pick individual stock winners is a pretty hard thing to do. It's a bit of a fool's errand. So we'd want to ask, why are those single stock positions there? Or we could simply talk about having multiple different philosophies all at work, all at once. It's hard to keep track of. It's hard to pin down. The analogy that I really like, it's like being on 3 different diets at the same time. If you were on 3 different diets at the same time, for breakfast, you're doing the Mediterranean diet. For lunch, you're a vegan. And then at dinner, you're on the caveman carnivore diet. I don't know. How are you ever going to look backwards and track which diet has led to your success or which diet has led to your failure? You just can't quite do it. It's the same idea here when it comes to investing. And these are the kind of things that I'm thinking about when I'm looking at a portfolio and trying to understand the methodologies or philosophies that exist inside that portfolio. But I want to spend a couple more minutes talking now about that 4th filter, which I already alluded to somewhat, of looking at the individual securities. And I think it is really important to call it out as its own topic. Now, imagine a portfolio that's all passive funds, all index ETFs, a very logical balance of stocks and bonds, a logical balance of US stocks and individual stocks. And this portfolio checks so many of the boxes of sound long-term investing that we talk about right here on this podcast. But then there's also a 1% allocation to Berkshire Hathaway. Now, that allocation to Berkshire Hathaway has some meaning. And that meaning would be different if instead it was a 1% allocation to a triple levered NASDAQ ETF or a 1% allocation to a Bitcoin ETF or something like this. Those little markers tell me something about how this investor thinks. And anyway, it's just important when you notice these things, it's helpful hints, again, at how the investor or how the advisor who created the accounts in the first place, how they're thinking. Or here's another story. Looking at a new client's portfolio, it checked so many of the good boxes that I look for that I just mentioned right now. But the client was carrying an S&P 500 index fund, which of course is fine, but the fund was from a relatively obscure fund company, and this fund company charged a 0.42% expense ratio on their S&P 500 index fund. 0.42%. That's 14 times more expensive than Vanguard's S&P 500 index fund, which of course begs a question. Why is this person using that particular S&P 500 index fund? Now, there could be a totally legitimate reason why. I simply don't know, but that's the kind of thing that needs to be flagged and needs to be discussed. The specific securities investigation, this filter, also helps uncover concentration risks and overlap problems. Concentration and overlap. Concentration would be the example of someone having 15% of their portfolio invested in Apple. I think that's reasonably obvious why that's a concentration risk. But perhaps less obvious would be the person who has 50% of their portfolio in a total market, stock market fund, and maybe another 20% in an S&P 500 index fund. Now, this presents the problem of overlap. 50% in a total market stock market fund, 20% in an S&P 500 index fund. When I build a portfolio, I very intentionally want there to be as little overlap as possible. Because what overlap does is it creates accidental concentration. That's why overlap and concentration are kind of part and parcel of the same thing. In this example that I'm spelling out to you, of that 50% total market plus 20% S&P 500, you might not know, or maybe you do know, but inside of that total market fund, it's actually about 80% S&P 500. So that 50% total market fund is actually 40% S&P plus 10% mid-cap and small-cap stocks. So if you already have 40% exposure to the S&P 500, do you need a separate 20% additional allocation to the S&P 500? I would say probably not. But at the very least, if you're unaware that your total market fund actually contains a lot of S&P 500 in the first place, then you are overlapping yourself and therefore creating some sort of concentration risk. And then simply from an organizational point of view of keeping things kind of nice and tidy, if I really wanted that to be my allocation, I would much rather have 60% of my portfolio in a dedicated S&P 500 fund and then 10% of my portfolio dedicated to small and mid-cap index funds. There would be 3 distinct funds, almost zero overlap in terms of what those funds contain in their underlying holdings that I would allocate to specifically to meet my large cap and mid cap and small cap needs. It's about using the right tools or the right ingredients to meet your specific portfolio desires. And when I say the right tools, I mean, the analogy here would be like tools in a toolbox. If I decide to carry a Swiss Army knife in my toolbox, and that Swiss Army knife has an actual knife blade to it and a Phillips head screwdriver and a bottle opener on it, okay, that's a fine choice. But then if I decide to carry that Swiss Army knife, do I also need a dedicated knife and only a knife in my toolbox? Do I need a dedicated screwdriver? Do I need a dedicated bottle opener? I would say it's inefficient and poorly organized to have these overlapping tools to have multiple items in your toolbox that actually take care of the same job. And I think the same exact logic should apply to our portfolios. When you look at the underlying holdings of a fund, just like when you look at the underlying tools inside of a Swiss Army knife, you want your underlying holdings in a fund to be unique and to not be overlapping with any of the other funds that you hold. That would be an ideal portfolio construction. And speaking of toolboxes, how about workbenches? And now we can think about benchmarking. Every investor, in my opinion, and that includes everyone listening here, ought to have a simple investment benchmark that they use to understand how their portfolio is performing over time. And picking the right benchmark, at least through what I've seen, is not common sense. I think a lot of people actually get this wrong. Many of the Americans that I speak with, I'll just use, I think most people listening, 90% of my listeners here are Americans, so I'll just use that. Most people who I speak to use the S&P 500 as their benchmark, period. So that's what they use to measure their performance. Now, if your portfolio is 100% US large cap stocks, then sure, I think using the S&P 500 is a perfectly reasonable benchmark. But if you own any small cap stocks or any international stocks or any bonds or any real estate or anything else under the sun, then using the S&P 500 as your one and only benchmark simply does not make sense. Now, part of this exercise, part of asking why, and part of looking at the individual holdings in a portfolio or in each account, part of that exercise has to be determining what the proper hypothetical benchmark should be for this portfolio. And then, of course, looking at the performance over time against that benchmark. So I'll put a pin in this topic, but if you're interested in learning more about proper benchmarking, by all means, please let me know. In my experience, I think most investors either don't have any benchmark picked out that they use, or they choose to use one of the common United States indices, the Dow Jones, the S&P 500, et cetera, and it's almost never the right benchmark to use. So in summary, when looking at all the individual holdings in a portfolio, it will create those type of conversations, the conversations that tell the story of why. Why does this investor own what they own? Now, why do those conversations make sense? Most often, those conversations help us fill in what's called the behavior gap. And that's the next big thing I want to touch on here, the behavior gap. The hidden info inside your brokerage statement helps fill in the behavior gap. Here's a quick ad, and then we'll get back to the show. Hey listeners, Jesse here. My team and I are preparing for episode 150 of the podcast, which we'll be recording in a couple weeks, and we thought it'd be fun to do an Ask Me Anything episode. And many of you know that my normal Ask Me Anything episodes focus entirely on retirement and financial planning questions. Well, we want episode 150 to be a little different. We're going to open it up to just about anything. Ask me anything you want. And I'm not slipping down the slope of becoming a self-absorbed influencer, but we figured, once every 150 episodes or so, it could be fun to share a little more than tax rates and expense ratios. So if you have a question, ask me anything. Simply send an email to jesse@bestinterest.blog. Thank you. The behavior gap is the difference between what actual returns an investment generates versus what the investor actually realizes. So that the difference between the returns that a fund or a portfolio generates versus what the investor actually realizes in real life. So obviously, or maybe it's not obvious, so I'll clarify here, but if the investor simply holds the underlying investments forever and they behave perfectly, then there is no behavior gap. The actual returns of the investments are one and the same as what the investor earns. But oftentimes there's a gap, and that gap is almost always a negative gap, where the individual person sees less of a return over time than what their investments would otherwise make you think they would return. And this behavior gap affects all sorts of investors, whether they're DIYers or not. Research consistently shows that individual investor returns lag the funds they're invested in by, on average, somewhere between 1% and 2% annually. And this is not because of fees, but almost always usually due to timing decisions made during volatility. Your statements don't show that. The statement never shows what you would have had if you had held steady in 2008 or 2014 or 2020 during COVID or 2022 during the interest rate spikes. Your statement does not show that. Your statement only shows where you ended up. Ruben Miller, who joined me on episode 133, he's got a great talking point on just this topic. The way he explains it is that every single investor, that's you, that's me, that's everyone, every single one of us, we each live our one specific investment life. And we thrive or we fail, or we probably do a little bit of both based on our one stream of investment returns. And if we goof up or do something stupid, something that might hurt us, that damage has a permanent effect, a forever effect on our one and only investment life. It's almost like a scar. It's an injury that happened once, but then you can see the evidence of it forever. It's like a scar on our portfolio. Now, the thing is, though, you see it, but it doesn't actually show up in the statements. It doesn't, if I'm sitting here, I'm recording right now on the end of June 2026, when my June statement shows up, it will not show the fact that I might have made some stupid mistake back in 2014. It's not there. I have to have the full picture of my investment timeline in order to realize, oh yeah, that scar is there. And really, it still does affect my portfolio balance here 12 years later. So here's a simple example. Imagine this, again, very simplistic investment timeline where someone invests $10,000 per year for 40 years, and it compounds at 10% every single year. Very simple, way too simple, but it's perfect for our purposes. $10,000 a year for 40 years, compounding at 10% per year. However, we'll say that in year 10 of this timeline, our investor makes one single mistake, and it ends up being a $10,000 mistake, or the equivalent of 1 year's worth of contributions. So again, 40 years of total time, contributing $10,000 a year at a 10% growth per year, with one $10,000 mistake in year 10. That mistake is a scar. But the question is, how big of a scar? The answer is that the scar grows to be about 4% of the final portfolio value. The scar size ends up compounding to $175,000 on a $4.4 million final portfolio value. That's a pretty big mistake. It was a $10,000 mistake in year 10, but if that mistake had not happened, our investor would have $175,000 extra at the end of our timeline. Those kind of mistakes, that's the behavior gap, really can matter. And when you're looking at your statement here in 2026, there is zero evidence of that panicky mistake you might have made in 2020. The past occurrences of the behavior gap are totally invisible on today's monthly statement. Only through the historical digging of years of investment returns does that reality actually come to light. So that's the behavior gap. Now I'm going to pivot to the next thing I look at on an account statement, or just the next thing I would encourage you to look at, which would be fees. Now, I hinted earlier at some pretty big fee information back in the opening of this episode, differentiating between explicit fees and implicit fees. Now, I'll start with the explicit fees because that's kind of easier to explain. Some of the most common explicit fees, depending on how your account is structured, would be things like commissions, a per trade charge. Most brokerages now offer $0 commissions on US stocks and ETFs, but maybe commissions still apply in your accounts to bonds, certainly to options, maybe even to some mutual funds. So again, if you see some sort of trading fees or commissions, those exist, and those will show up in your account statement, and they'll be explicitly stated. You'll see them right there. Similar to that would be something like a mutual fund load. I really, really hope you're not paying mutual fund loads. But many people out there still are subject to one-time loads. It's a one-time fee. I don't know why they call it a load, to be honest with you. But essentially, it's when you buy or sell a mutual fund. Usually, it's not both. Usually, depending on the fund share type, it's either when you buy it or it's when you sell it. But these load fees are often as high as 5% per purchase. You buy $1,000 worth of a fund, they skim $50 as a fee right off the top. And you mean 5%? That's a really big fee, obviously. So if you are paying those, it'll be very apparent on your account statement. The next one would simply be account fees, stuff like annual maintenance fees or inactivity fees or paper statement fees. Again, your brokerage hopefully is not charging them. If they are, hopefully they're very, very small. For example, a lot of 401ks accounts charge some sort of annual fee, usually be some kind of like $25 record keeping fee. And if you've got $10,000 or $50,000 or $1 million in your 401k, a $25 annual fee is pretty small. It's just good to be aware of whether it exists or not. The next one that's relatively common, a transfer or a wire fee. So if you move your account from, say, Fidelity to Schwab or Schwab to Vanguard or Robinhood to M1, I don't know, oftentimes there will be some sort of transfer fee. Maybe it's a $50, $75, $100 fee associated with that move. The next big one would be an advisory or a management fee. So if you're in a managed account or an advisory account, this could mean that you have Vanguard advisors helping you in your Vanguard account. It could mean that you have an independent advisor helping you in your account, an independent financial planner with investment oversight of your account. If they're charging you fees, some of them are charging fees right out of your investment accounts, and those fees are explicitly stated right there on your account statements. Could be a flat fee, could be a quarterly AUM fee, or something else altogether. So those explicit fees are all right there on your statement for you to see. They're clear and obvious. Granted, they do appear on those kind of data dump pages at the back of your statements where it's just line by line by line by line, meaning that plenty of investors never actually dig into them, even though, again, they are right there for you to see. But there are implicit fees too. By definition, we don't see these fees at all. They're not explicitly written out in your statement, but they do exist. They very much exist in terms of a slow drain on your actual portfolio numbers. I've ordered them here in what I think are just the most common and most important ones. The first one would be expense ratios, fund expense ratios. Fund expense ratios are the annual cost of owning an ETF or a mutual fund, and that's deducted from the fund's value as a slow drip that occurs every single day. It never appears as a charge to you, and for what it's worth, things like 12B1 marketing fees are bundled inside of this. It's so important to understand the expense ratios of your funds, and this is exactly why, because you're never going to see it as an explicit line item on your statement. It's just going to be a slow drag on your account, whether you're aware of it or not. And if you're wondering, how can that be? Or that doesn't seem fair, or that doesn't seem right. The rationale is that if you're Vanguard or you're Schwab or you're Fidelity, and let's say, one of you out there is invested in BlackRock's target date fund. BlackRock charges a very fair and low expense ratio, but you're holding this BlackRock target date fund inside of your Fidelity investment account. Now, Fidelity, whenever you log into your account or whenever you need to see your statement, Fidelity is simply going to report to you what the value of those BlackRock shares is. Fidelity probably doesn't know, and they certainly don't exactly care, whether BlackRock implicitly charged you a fee during the most recent period inside of that fund. They're just going to say, your shares were worth $151 per share last month, and this month they're worth $156 per share. Here's the data you need. Now, what you don't actually realize is that during that time, BlackRock, they said, the stock market's up, the bond market's up, so your shares went up. But also, in order for us to pay ourselves, we kind of dialed down the value of your shares a little bit. We scraped some money out of the fund, and we put that money into our coffers. That's the way that mutual funds ETFs work. It's an implicit fee. It occurs all the time. It's a slow drain on your portfolio. And it's just very important that you understand how slow or how fast of a drain that is. So know your fund fees. The next one would be cash sweep drag, which is definitely a strange sequence of words if you're not familiar with what this is. A cash sweep is some sort of automated transfer of idle money or excess money from your brokerage account into a secondary interest-bearing account, and that cash sweep occurs at the end of every business day. So basically, the Schwabs and the Fidelities and the Vanguards of the world, they move your excess cash into a place where it actually bears some interest. But many brokers, in fact, most brokers, they sweep your idle cash into an account with a pretty low interest rate. So the broker isn't paying you anything or barely anything on your cash, but they will turn around and then they'll use that cash to secure the overnight interest rate for themselves, which as of now is in about the 3% range. Now, if you knew what was going on, or if you were kind of paying attention on a daily basis, that should be and would be your 3% interest that you are receiving, but it's not. And so unless you know what you're looking for, which hopefully you do now that I've explained it to you, if you didn't know what you were looking for, you wouldn't realize that you're essentially suffering an implicit fee right there. The excess cash in your account ought to be receiving the overnight interest rate, which would be the equivalent of like a high yield bank account or the equivalent of a one-day treasury or the equivalent of a money market fund. It's all going to be about the same thing, which again, as I'm recording this, somewhere in the 3 to 3.5% range. But a lot of the brokerages of the world say, no, we'll give you 0.5%, and they're keeping the remainder on your money. So again, be very aware of that drag, that slow drain on your cash balances. The next implicit fee would be the bid-ask spread, which essentially is the gap between buy prices and sell prices on any given trade. So all the time, that gap always exists on any given trade. That difference is collected by the broker or the dealer or the market maker who's making the trade. Depending on what kind of assets you're buying or selling, this can be a major source of inefficiency. It certainly becomes a major source of inefficiency as you trade more and more and more frequently, which is just another good reason to intentionally choose to trade as little as possible. If you're trading very little, and you're also trading assets that tend to be very, very liquid, something that's traded all the time, just like a lot of popular ETFs and mutual funds are traded all the time, then your bid-ask spread is probably very, very small, which is good. And it's also occurring very infrequently, which is also good. So again, probably not a major source of inefficiency for most of you listening right now. But related to that bid-ask spread would be payment for order flow. So your broker might sell your order to a third-party market maker, and long story short, it's going to show up to you as a slightly worse execution price. You thought you were buying shares at $100 even, but instead, by the time the trade goes through, you bought your shares at $100.05. Or you thought you were selling them at $100, but instead you only get to sell them at $99.95. That gap between what you thought you were buying and selling them for and what you actually buy and sell for, that's an inefficiency that costs you in the long run. If you're interested to learn more payment for order flow, or you can Google high frequency trading, there's some interesting, I think there's a 60 Minutes interview out there about high frequency trading, which is about exactly this topic. Michael Lewis, who wrote The Big Short, among many other books, wrote a book called Flash Boys, all about high frequency trading and payment for order flow. So anyway, all these different implicit fees, as I call them, occur in many of your accounts every single day, every single month, every single quarter. And they are, to some extent, a cost of doing business. We all suffer them. But when you do it right, so to speak, they only add up to a very, very small drag on your portfolio. And so the question becomes, are you doing them right? I think that's an important question that your statement alone simply will not answer, because your statement doesn't show those implicit fees. You need to dig into more detail to understand it yourself. And that wraps up my thoughts on the fees on your account statements. But what else do we need to be aware of when looking at account statements? We certainly want to be aware of the tax picture. Taxes are basically invisible when we look at an account statement. The statement shows your balances, it shows your pre-tax wealth for sure, but it does not show how much of that money you'll actually get to keep as you withdraw it. Your retirement plan, your long-term financial plan, it needs to be built around the idea of after-tax wealth. And for a lot of people, pre-tax wealth and after-tax wealth are meaningfully different numbers. So what kind of things am I looking at specifically? I'm looking at which accounts exist and which accounts don't exist. We're talking about traditional pre-tax accounts, Roth after-tax accounts, taxable brokerages, HSAs, 529s, donor-advised funds, et cetera, et cetera, et cetera. In many cases where a particular account does not exist, I want to know why. So there's that question again, why? I also want to understand the proportional sizes of these various accounts. It's too easy in the hypothetical world to assume that your tax buckets are equivalent in size. They almost never are. Most commonly, I would say, an investor's pre-tax traditional accounts are largest. And then usually the Roth accounts and the taxable accounts are a very distant second and third. And this common setup with a proportionally large pre-tax bucket means that the investor's pre-tax wealth will be quite different than their post-tax wealth. It's really important to recognize that fact. Large traditional accounts are certainly impressive assets. Many retirees have millions of dollars in their 401ks, but the cynical joke is that only 80% of that account is actually yours. The rest is Uncle Sam's. And by age 75, you have required minimum distributions from those accounts, which can push your income into ranges that trigger IRMA surcharges and increased Social Security taxation and state-level tax exposure. And that reality is invisible when looking at just today's account statements. And also, the account statements don't show you any sort of tax drag that you're suffering from asset location. Granted, as I mentioned earlier in this episode, and I've shared on this podcast multiple times now, that tax location, tax drag idea, it's a hyper-specific phenomena. For some of you, it probably won't even move the needle. For others, though, it could save you tens of thousands of dollars over your retirement. Tax location, again, it might not be your saving grace, or it could be a really big deal for you. But the idea here is that most people have never deliberately mapped out which assets belong in which account types. Bonds in a perfect world wouldn't live in your taxable account. Bonds create taxable income every single year. You'd prefer to shelter that annual income inside your traditional IRA. Stocks, on the other hand, are quite tax efficient. You might not mind owning stocks inside of your taxable account. That's fine, all good. But there's actually a much bigger tax concern that I care about when reviewing account statements. Some statements actually make this data quite clear. Other statements are much harder to decipher, but in either case, this is the kind of data buried deep inside your account statements on those back pages where it looks like a giant spreadsheet in tiny font. And that concern is unrealized capital gains. One of the consequences of smart long-term investing is that your assets grow and grow and grow over time. And that growth, at least inside of a taxable account, can be taxed by state and federal governments. Of course, these capital gains are a great thing to plan for and a great thing to plan around. On a federal level, they can be taxed as high as 24%. Technically, it's 20% plus an additional 23.8, but still 23.8% tax. But they can also be taxed as low as 0%. Now, that's a very big difference. The account statement doesn't explicitly explain these taxes. So we need to be aware of capital gains, unrealized capital gains, how they could be taxed if we did realize them, good years to realize those gains versus bad years to realize those gains, and how that income affects all the other moving pieces inside your financial plan. So what else is not covered in your account statement? How about account registration and account titling, which would be things like an individual account versus a joint account, something with a rights of survivorship versus tenants in common, community property, transfer on death, accounts that are held in trust. Statements rarely make that distinction clear, but it has a very big effect on whether assets pass by survivorship or by beneficiary or by probate. So there's a big estate planning consideration that is often overlooked if you're just looking at an account statement. I kind of mentioned this before, but beneficiaries, on any sort of IRA account or 401k account or 529 or things like that, HSAs, you want to know who the primary and contingent or any other level of beneficiaries are for all your accounts. Ideally, you'd want to know if they're designated per stirpes or per capita, which again, that's more of an estate planning concern. But the fact of the matter is that your account statements themselves probably don't mention this data. If they do, it's probably buried in the back pages, but it's very important to know for every single one of your accounts. You probably won't know either if there's a power of attorney or an authorized trainer or some sort of authorized agent on the account. For IRAs, you might not know just looking at the account statement if RMDs are due, if the RMD for this year has been paid, what the calculation for this year's RMD would be. And for inherited IRAs, it would work the same way. And for an inherited IRA, you would want to know things like the applicable distribution timeline. Again, most new inherited IRAs these days are all subject to the 10-year rule. So what, 10 years? 10 years from what date? When is my 10 years up? Those kind of things probably are not listed out on the account statements. Neither would be things like dividend reinvestment elections. Again, for a lot of accounts, we want to turn on automatic dividend reinvestment, but sometimes there are very good reasons not to. Maybe you don't want to turn it on because you're worried about your rebalancing practice and you just want to accrue some cash from dividends and then reinvest it according to your rebalancing schedule. Or what makes a lot of sense would be if you're in a position where you're retired, you're withdrawing money out of your portfolio on a regular basis. The first place I would withdraw that money from would be dividends, especially if it's dividends inside of a taxable account. I don't want to reinvest those. I just want them to accrue in cash so I can withdraw them for my next month's required withdrawal, those kind of things. And anyway, my point is that those dividend reinvestment elections probably are not listed out on your account statement. Another good one would be your linked bank account. Where do you send money to from this investment account? Is there some sort of standing distribution or standing contribution instruction on a weekly or monthly basis? That is probably not listed out. It's certainly not in an obvious place on your investment account. So when it comes to these account logistics, I'll call them, none of it is particularly exciting, but all of it is worth knowing. Maybe not that much of this episode was particularly exciting, but it's very, very much worth knowing. Your investment account statement reflects some very important information, but is also missing a lot of vital information. It reflects what you own, but your plan needs to reflect what happens to that money and to the people around you if something were to happen to you. So as we close out this episode, I put down kind of 5 questions in review, 5 questions based on everything we just talked about today. And as you think about your answers to these 5 questions, I wonder if you have a comfortable answer to all 5. I will admit, I do not have a comfortable answer to all 5 of these questions. And I think if you have some discomfort as I go through this list, maybe that'll push you to take some action or to think about it this weekend and log in and get some good answers to the point where you are comfortable with what I'm talking about here. So question 1, do you actually know your all-in cost of investing? Do you know your explicit fees, but also every expense ratio, every sweep cash account interest rate versus what you could be getting on that cash, every implicit drag, which candidly might just be an estimate, and what that all adds up to annually? Do you know your all-in cost of investing? Question 2, if someone asked you right now to explain the consistent investment philosophy behind your portfolio, could you do it in 2 sentences? And one thing I'll say is that having interacted with hundreds of my listeners. I know that many of you could hit an absolute home run on this question, which is awesome, but I suspect that some of you might not be able to explain the consistent investment philosophy behind your portfolio. Question number 3, what percentage of your stated portfolio balance will you actually keep after taxes? And are you taking a guess with that, or have you actually calculated the number? Question 4, has your portfolio ever made you panic, and did you act on that panic? And does your portfolio have some scar tissue from years or decades ago? And question number 5, if a meteor came down and hit you in the forehead, would your spouse or family member know where every account is, how to access it, and who it passes to without having to call a lawyer first? So those are the 5 questions. The numbers on your monthly statement do not answer those questions. There has to be more thought and more expertise involved. And if one of those questions made you think, I don't actually know the answer to that, I think that's why that stuff matters. That's why this episode matters. Your statement is a great starting point, but it's not the whole story. It's not even close. If you do want more help working through any of this, whether it's reviewing your own portfolio, thinking through your tax picture, or just figuring out where to start, please head over to planwithjesse.com. I would love to talk to you. And if you got something out of today's episode, please leave a rating and review on Apple Podcasts. It takes about 47 seconds, which, as we established today, is exactly how long most people spend looking at their quarterly investment statements. Thank you, as always, for listening to Personal Finance for Long-Term Investors.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.